Active versus passive investing. Which strategy is right for you? When it comes to investing, there are two schools of thought: active investing and passive investing. Knowing which one is right for you is critical to your investing success. Pick the wrong one, and there is a high likelihood you end up losing money. Pick the right one, and there is a high likelihood you end up making money and will be a successful investor. But which one is right for you? Only you can answer that question. And this episode is going to help you figure it out. In this episode, we'll take a look at what active and passive investing means, reasons why people try both active and passive investing, 3 advantages and 2 disadvantages of both active and passive investing, plus 1 trivia question about investing. Today's trivia question is, aside from passive and active investors, what is the third category of investors called? We have also included the timestamps in the description below if you want to revisit any particular section of the video. Let's get started looking at both active management and passive management in detail so you can pick the best one for you and your goals. Active investing. Active investing entails buying and trading stocks in the middle of market fluctuations. It's a hands-on approach toward the stock market that requires consistent monitoring on the part of the investor. Through active investing, shareholders work to beat the ups and downs of the market by analytically selecting investments they believe will perform well. And, unlike passive investing, active investors typically seek short-term financial gain. For example, in terms of buying and selling, you're looking to make a short-term profit on the price changes of an individual stock. You actively are trading investments either daily or weekly in an attempt to maximize profits. Another form of active management is changing your asset allocation. For example, you might have an allocation made up of 60% stocks and 40% bonds, but fear a recession is coming. As a result, you reduce your stock exposure to 40% and increase your bond holdings to 60%. Doing this will protect your money from losses should the stock values drop. Why do people try active investing? There are so many reasons why an average investor might want to try active investing. Top of the list is that active investors want to play a bigger role in managing their money. They don't believe the idea of buy and hold to make a profit. Plus, some active investors don't trust investment advisors. Other investors prefer active investing because of the low risk involved. They constantly monitor the market to know when the prices of stocks are likely to drop, and thus they pull out their money for safety. What do active investors invest in? Active investors are known to invest in a wide variety of assets, some of which are stocks. Stocks allow active investors to target specific companies that feel would perform well. Bonds. Active investors pick bonds because when interest rate falls, the prices of bonds tend to increase. Options. Active investors are involved in options trading because it allows them to make bets on the changes in a stock's price. Exchange-traded funds, ETFs. ETFs allow active investors to buy and sell multiple assets from a single fund. Commodities. Commodities like corn, oil, wheat, and natural gas allow investors to speculate on future price trends. 3 benefits of active investing. 1. Potential for higher return. Since active investing involves the buying and selling of investments, you can potentially outperform the market if you're able to find some undervalued stocks and make the right trade at the right time. The annual return could be much higher than the market in any given year. 2. Professional management. Actively managed mutual funds are run by a team of managers that oversee the funds and make decisions when to buy and sell. Since the active fund manager is educated in finance, many people think they have a higher probability of beating the market and thus higher potential returns. In a minute, you will see if their track record backs this belief up. 3. Ability to play defense. When the stock market turns south, an active manager of equity funds is able to play defense to some extent. This means they can sell off some riskier investments and instead invest in safer holdings like bonds or cash. The changing of the asset class can help protect gains and limit losses. 3 disadvantages of active investing. 1. Typical below average return. While we said that the managers are educated in finance, many people believe they should be able to beat the market. Unfortunately, they don't. In fact, it is rare for a manager to consistently outperform the market. They may do so here and there, but not every year. 2. High fees. Because of professional management, actively managed funds tend to have higher expense ratios, otherwise known as fees, since you're paying for the professional management. This eats into your returns over the years. If you're still unsure why active investors are paying high fees, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. 3. Higher taxes. With an active approach to investing, you run the risk of paying more in taxes. This is because you will realize more capital gains over the short term. And since short-term capital gains are taxed at a higher rate than long-term gains, you could face a higher tax bill. Now let's take a look at passive investing. Passive investing. Passive investors buy investments that track an underlying index or create an asset allocation and stick to it for the long term. Passive investors limit the amount of buying and selling within their portfolios, making this a very cost-effective way to invest. The strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. For example, investing in a mutual fund or ETF that tracks the S&P 500 index is a form of passive investing. If you put your money into the Vanguard 500 fund, you are investing passively. This is because the mutual fund's goal is to simply return what the S&P 500 returns every year. Another form of passive management is setting an asset allocation and sticking with it for the long term. For example, if you were to pick an allocation of 60% stocks and 40% bonds, you stick with this allocation regardless. Why do people try passive investing? As with active investing, there are so many reasons why people try passive investing. Some of the reasons include passive investing is easier to manage when compared to active investing. Plus, passive investing requires rebalancing your portfolio once after a few months. Investors prefer passive investing because they don't have to time the market. They can invest and still concentrate with their regular jobs. Additionally, some investors believe that passive investing brings better performance than actively investing. What do passive investors invest in? Passive investors are known to invest in a wide variety of assets, some of which are mutual funds. Passive investors pick mutual funds because it holds several stocks and bonds, which is good for diversification. Exchange-traded funds, ETFs. Passive investors invest in ETFs because they have lower expense ratios compared to mutual funds. Stocks. Investing in stocks allows investors to hold the stocks for a long term. Bonds. Passive investors may also include bonds in their investment portfolio. 3 advantages of passive investing. 1. Low cost. Passive funds don't have professional managers that need to pay attention to the market and make trades and modify holdings on a regular basis. They simply invest as the underlying index is set up. Therefore, the management fees are much lower, which pays off in the long run. 2. Get what the market gives. You're never earning less than what the market returns when you invest passively. You're always going to get what the market returns, be that good or bad. 3. Simplicity. Passive investing is simple. You pick an allocation and some passive mutual funds or exchange-traded funds and you're pretty much done. You don't have to monitor the market daily to make any changes or try to take advantage of price swings. 2 disadvantages of passive investing. 1. Never return more than the market. While a benefit is always earning what the market does, you never beat the market. To some, this is an issue, but if the market returns on average 8% annually over the years, that is a solid return. 2. Lack of action. When the market drops, you're stuck with your allocation and investment since you aren't trading based on what the market is doing. To some, this makes investing boring. Now that we know the differences between the 2 investing strategies, which strategy is the better long-term option for your investment dollars? Which investing strategy should you choose? The approach you choose ultimately depends on your risk tolerance and financial goals. If you prefer short-term and cultivated wealth growth, you should consider active investing. Because of excessive trading and management fees, it's also great if you don't mind paying more for a potentially greater return. But if a hands-off long-term approach makes more sense with your saving goals, passive investing could be right for you. This style is also good for those looking for low-cost, tax-efficient investing. However, each style presents advantages and disadvantages, so you'll want to weigh those of each before making a final decision. It's also important to remember that no stock or investment comes without risk. Whether you actively or passively invest, you should prepare for a certain level of risk. Even blue-chip stocks are affected by stock market fluctuations. While the market's volatility can't be controlled, your approach to investing can. Therefore, the style you choose should reflect both your saving goals and your risk tolerance. So, back to today's trivia question. Aside from passive and active investors, what is the third category of investors called? The third category of investors are known as pre-investors. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.